focus on this later, but that's mainly due to the strong Singapore currency, where we saw a spike in terms of or more outbound traveling. On retail rental reversion, for the first 3 months of the year, we achieved a positive rental reversion of 11.4%. And weighted average lease expiry remains high at 7.4 years. In terms of the tenant retention for the retail tenants, remain healthy at 90% by NLA. So on the office rental uplift, Sky Complex Building 1 and 2 achieved 1.2% of rental uplift effective April this year. On the lease expiry profile, we have renewed most of the major leases, so we only left with 6.4% by NLA and 12.1% by GRI for the rest of the year for FY 2025. So office tenants continue to account for approximately 21% of our portfolio GRI, and that is to ensure stability in cash flow. And our top three tenant categories remains at F&B at 29% approximately, fashion and accessories at 12.6%, and also government at 11%. So the government here refers to our Singapore's Ministry of National Development. Zooming into the retail portfolio, earlier I mentioned that we achieved the 11.4% rental reversion, and overall portfolio occupancy remains high at 99.9%. For GEM, is actually fully occupied. For 313 at Somerset is doing at 99.6%. And on the left-hand side, the tenant sales chart, you see that the first 3 months of the year, it dipped slightly to 5.7%, and that's mainly due to the strong Singapore currency, where we saw more outbound traveling. And also for GEM, if you recall, right, there is this train disruption in September. So that 1 week of closure also slightly affected the sales at GEM. And for 313 at Somerset, if you visited it recently, you notice that level 5 Food Republic, it is undergoing some renovation works. So half of it has opened, and the other half is still undergoing renovation. So that affects slightly on the tenant sales as well. On visitation, it is trending still quite close to pre-COVID-19 average. So on the office portfolio, on Singapore. Singapore is still fully leased to Ministry of National Development, and there will be a rental review once every 5 years. So the coming in December, which is next month, there will be the next second rental review, and we will maybe update the unit holders at appropriate juncture. And over to Milan, occupancy improved slightly to 75% this quarter, and compared to last quarter, we were doing at 73.9%, and that's mainly due to the leases. We secured more lease for Building 3, and we continue to see a good leasing progress for Building 3 as well. So for this one, for this 3 offices building in Milan, there's a rental review once every year, and it's pegged to the CPI index. So for our lease expiry, weighted average lease expiry profile for the office, it is still a very long lease at 12.2 years by NLA and 14.5 years by GRI. And also, we continue to transform or aim to transform Milano Santa Giulia into a vibrant business city. So this is where our 3 office buildings are located, and with the Building 3 repositioning to secure multi-tenancies, we are collaborating with our tenants to make it into a more vibrant city business area. So we invited the tenants down to occupy the space and also create some activities for the residents over there. So we aim to actually create a work, play, and life city. So these are the new F&B and retail offerings for shoppers. So if you could look at the left top, the two photos. So these are the photos for the Food Republic before renovation and after renovation. So we plan to launch or bring in some mini restaurants at the Food Republic. So we also brought in Tim's Signature. So this is one globally it is Tim Hortons' first signature outlet, and is located at 213. So it offers like elevated coffee house experience as well. On capital management front, we have a 360 million loan up for refinancing in this financial year. So we are already, or we have already commenced the process of arranging for the refinance due in this year. So we'll keep unit holders updated on the progress. And as at the end of September, the debt facilities available, it remains at 171.1 million. On gearing ratio, it dropped slightly this quarter from 40.9% to 40.7%. And in terms of the weighted average cost of debt, it increased slightly from 3.58% to 3.74% per annum. And that's mainly due to the replacement of the euro loan that we refinanced in October last year. So for for moving forward, we can see that we can take it as the 3.74 as a stabilized rate, because this is reflective of the last quarter or the remaining quarter of the euro loan interest rate. So approximately 70% of our borrowings are hedged to fixed rates, and also sustainability linked financing accounts for about 85% of our total committed debt facilities. So the next two slides is actually an overview of how we progress in terms of sustainability. And moving forward, we focus on environmental, which is the energy consumption, and water management as well. So with that, we have a shorter term target for this one by FY 2027. We aim to reduce our energy consumption by 10%, and also the water consumption by 2% by FY 2027. And these are some of the awards that we achieved during the quarter as well. So looking forward, we will continue to focus on proactive asset management and also prudent capital management to manage our costs and gearings. And also we continue to drive our progress towards our ESG targets. Market review, I wouldn't go through because these are some market statistics for the unit holders to refer to. And the rest are ancillary slides, which I wouldn't go through as well. So maybe with this, I'll pass the time back to Darren and Kelvin also to commence the question and answer.
Yeah, thanks, Bilin, for the presentation. Yeah, so just a quick reminder that if you have any questions, feel free to just type them into the Q&A tab, and the management will get to those questions, which is now. Yeah. So let's begin. The Fed is cutting rates, yet 10-year is still rising and rose to 4.5% recently. Jerome Powell recently said Fed is in no hurry to cut rates. What is your view regarding interest rates going forward?
Right. Can you all hear me?
Yep, we can.
Okay, that's good. Yeah, I think this is a very interesting question, and also that question is a $1 million question. It can tell you the specific answer. I think that will help a lot of people to become very rich. But I think fundamentally, what we're trying to do is to actually get ourselves in a very disciplined manner to sort of manage our overall profile between the hedge and unhedged. And if you did follow us previously, you know that we do actually increase our hedges from 61% to 70%. I think this is the comfort level of hedging percentage that we are talking about. So is to always give us a small exposure to the unhedged portion to take advantage of any kind of rate cuts. For example, if you are also looking at the whole interest rate yield yield curve, you know that I think the spot rate, be it 1 month or 3 months, Sora actually has dropped, I think, easily 40 basis or even 50 basis point uh, since the rate cut has started from US. So in that case, I mean, if that I will take into comparison of what we are positioned earlier in June to now, I think the position has improved. So I believe that in the macro environment, when now Trump has won his as a president going forward, I think the things that he's trying to do is hopefully is trying to grow his U.S. economy, and with that, I think he need to have set the interest rate in a very reasonable manner. At the same time, of course, he always trying to drive the cut of corporate rate to for US to around 15%. That that itself will certainly need again a very strong push on also maintaining a reasonable level of interest rate in order for it to actually improve on the whole vibrant, robust kind of economic growth in US. I think that is something that they will have to consider. Of course, with that also they need to balance between the government bonds subscriptions and how you can sort of continue to maintain attractive kind of bonds issuance and all those things for the whole uh, I think US economy. So these are things that of course uh, that's why I started off is that it might not have a clear crystal ball now, but at least we know that interest rate is actually uh, on I mean probably close to a ceiling already at in a verge of coming down. So it's a matter of how soon, how fast, and how low it can come down. That's all. So with around 30% unhedged portion, I would think that our position is actually favorable. If let's say there's any kind of interest rate cut, and this interest rate cut will means a lower all-in cost to us. So I would say while we are not sure how this U.S. Rate cuts going to plan out going forward, but I think the likeliest direction will be going down, and the likelihood is that we will be able to benefit from that. Not only us, but I think most of the REIT, but of course those REIT with a higher hedge percentage means that they actually might not benefit as much. I think the other things that to also keen to share with you is that those REIT that actually yet to reset their hedges that they have maybe few years ago when the rate hasn't been going up yet. I think again that will be an issue for them. So watch out on those REIT. But I think for our REIT, technically we have already reset most of our hedges to the current rate. I think one. Secondly is that we will certainly be able to benefit if let's say the interest rate will come down. So I think hopefully this gives you some color on that.
I see. Yeah, there's a follow-up question regarding the $360 million loan that's due in 2025. So currently the rate is 3.74. Yeah, so what's the expected rate on this new refinancing, and what will be the change in the total cost of debt, as well as what will be the likely impact on DPU?
I think the blessing is that I think those loans that we have is mainly the IPO loan, which I think earlier days people don't really know about us, so they do actually provide a higher margin, which is a safety margin for them when they actually provide us with the loans. I think after they get very familiar with our portfolios and also with the addition of GEM, I think the portfolio is even more stabilized. I think we managed to actually get a very good saving on the margin. You know, when it comes to a loan, it's always margin by Sora. So if you save on the margin, then technically it's a good saving. If let's say Sora stay flat, I would say that if let's say I were to base on what we do the same hedges again based on the current Sora, I think our overall cost should be still within what we have now, which is within the overall cost that we're talking about. But again, as I share, is that if let's say Sora were to continue to go down, I think we will benefit from that. But I think maybe the audience also might also want to understand is that I think sooner than later, maybe some of the countries might move away from how the Fed rate is going to trend because they might actually want to grow the economy faster, and they might want to be more reactive to the global market to attract investors. So they might be start to cut their rate even faster, or balancing their rate even faster. So that is something that you also have to keep a watch. But I would say that if, let's say, you just generally keep just generally agree that the Fed rate is the key movement, I think it's not wrong also. But I think some of the countries will go faster than what US is doing. Yeah.
I see. Yeah, thanks for that. That's very clear. Yeah, let's move on to tenant sales and retail rents. Yeah, so noted tenant sales are down 5.7%, though
Mm.
rental reversion was positive 11.4%. So what
Mm.
role does tenant sales play vis-a-vis rental agreements, and are there any percentage sales tied to rental leases?
Yeah, maybe I answer the last question first. I think the percentage tied to rental leases there's no I think the answer is no. But we do actually set in the agreements that, let's say, the tenants exceeding certain sales number, they have to pay more rent. But we always have a fixed component to most of the tenants, or rather all the tenants. So as to the whether there's a correlationship between tenant sales to the renter, I think if you talk about ops cost, which is basically renter divided by the overall sales of the tenants, yes, I think basically that were sort of is a very clear mechanism for us to use to set the tenants renter for the retails. The retail tenants renter. I think that is a general way of gauging it. But if you talk about current drop versus what has been pre-COVID, I think you should realize that actually compared to pre-COVID sales, the sales number has moved up by around 20%. So that means that the ops cost, which is our rental divided by the overall sales of the tenants, still actually at the low side if you factor in that 20% increase. So while my colleague Bilin was sharing with you guys on the drop, of course there are a few temporary factors, which mainly because of the trains that going to the west of Singapore, basically have some disruptions for a week. That one is a serious one. I think the other one is that I think some of these tenants, including uh, the Food Republic, are doing some refurbishment on the premise. I think again, that's something that is also a temporary things. But I think for us is that we continue to look at tenants that can able to bring good sales and good footfall, and put into our tenant mix and replace those that is low, so that that will give us a very good way of improving our renter. And also, as you rightly pointed out, sales number do actually matters to the tenants. Of if they don't perform, they can't pay you rent. I think that is the fact of life, right? But the thing is that if they can perform, and they should actually pay you a good reasonable rent, because the ops cost that we use is a very good gauge, because it might not be only within the mall but across the whole industry. For example, F&B ops cost is around 20%. Across it, if they pay lower than 20%, I think you got always a uh, good chance to increase the rent. I think that is something that I just want to highlight to you. But so constantly changing the profile and see how you can improve the sales number is important. But don't worry about too much on this temporary drop. Although I might not say that this temporary drop is a big concern, but it might not be as alarming now unless we have a clear trends going forward. But at this moment, seems to be a good. It seems to be some temporary impact to some of the operational movements that is happening in the mall. That's all.
I see. There's a follow-up. Other than the low occupancy costs, from the perspective of the tenants, why are they willing to pay so much positive rent reversions, even though like the retail sales also really seems like it's really moderating at maybe around 20% above pre-COVID. So from the perspective, like why can they pay more? Do they see more
I think
sales, or yeah?
I think the fact is that the renter did actually adjust downward during the COVID period. If you look at a normal kind of rental review, is renter for a lead retail is actually 3 years, right? Now is the payback time for the landlord. I mean, the landlord probably earlier days do actually have some compromise on the renter because of COVID, because sales number doesn't actually achieve and all those things. But now sales number actually achieve uh, after the COVID has behind us. I think that is probably the start of the payback period. So last year we enjoy a very good rental uplift. I think I will believe this year or so will also be because the COVID did last for around 2 years plus, and that is when all the retails actually enjoy a lower kind of rental compared to the sales number.
Mm, I see, I see. Okay, moving on to the office. How optimistic are we getting good positive rent reversions for the office rent renewal in Singapore? Is
I,
demand supply conditions favorable for higher rents?
I think I like this question because this audience that asked this question certainly follow us very closely. That's why that they know there's a random reversion for the Singapore portfolio, Singapore office, which is I think thank you so much, and I think we are quite positive. I think it will be something that we can see a good uplift of the rental given this review is actually every 5 years, and we based on previous 5 years how the rental move. I think generally it went up by quite a reasonable numbers, probably close to double or is a high start double digit kind of numbers that we are talking about. So if let's say that is a gauge for us to sort of demand for a high rental for the Singapore office, I think certainly we shouldn't be too shortchanged by that, and we should be able to get a very good renter. So while I cannot disclose too much because it's still in the negotiation, but I think that if you based on the whole office trend, how it goes for the suburban offices, I think at least you can form a view that it should be something that is rewarding to the unit holders.
Mm, I see. Okay, can you share what is your recent change in NAV or valuations of your assets?
Mm, I think the recent change is because we do actually increase uh, loan. I mean, we do actually increase some higher loan because we need some working capitals to sort of for some of these major negotiation and capex what we are talking about. So we do actually increase some of the loan. Other than that, also we do actually have more unit because now the unit, especially the fee, actually pay in units. And also at the same time, we do actually issue this distribution reinvestment plan. Again, that will also increase the unit. So if let's say you talk about NAV per unit, it actually did increase. It did actually reduce because of the base of the unit is larger. If you're just talking about NAV itself, it's mainly due to without the impact of the unit, is mainly due to higher borrowing that we have for some capex and some kind of negotiation work with the tenants.
Okay. How do you balance geographic risks in Australia and Asia?
Mm. First of all, I mean, we didn't say we want to go into uh, uh, Australia. I think although Australia is our home ground, I think our parent is in Australia, but it doesn't mean that we will go into Australia. I think it's only one of the probably the most likelihood that we might go there, given that our parents is there and they could probably have a good connections and also good portfolios and things that we can sort of consider when we want to venture into Australia. But it's not surely that we will go there. I mean, that's one. And also, if you follow the REIT industry closely, you will also notice that I think some of the REIT actually acquired from our parents, but it doesn't come into our portfolio because we did actually look at the asset, but we don't think it's probably the right time to venture into a new jurisdictions uh, compared to where we are now. So I think our home ground, which is Singapore, is still one of the place that we want to grow further and better. I think if you were to understand our parents' investments in Singapore, I think you will know that we have close to around 10 billion Sing dollars of asset, which include like the PLQ, Paya Lebar quarters, also some of the investment we have. I think, for example, Parkway and all those other joint venture development project that we have is quite sizable. So we looking at those assets. I think is probably is enough for us to sort of consider for the next 5 to 10 years already. So we might not go into Australia unless we have a very good, clear pictures or understanding how we expand there, how will benefit the unit holders. Yeah.
I see. Yeah, there's a follow-up to that. What are your key priorities for acquisitions and disposals moving forward?
I think for me, I always feel that we should acquire something that is accretive. I think so. The key consideration for me is certainly something that is accretive and something that actually can bring on values or enduring values. I mean, first of all, it has to be enduring values. If it's not, there will be some value that we can unlock from the asset that make it very meaningful for us to put into the portfolios. So I think priority wise, of course, is also to see. To see whether we can optimize the portfolios. And basically, when we say optimize, we also consider divestment at the right time when we feel that it's at the right price, when we have already maximized the potential of the asset. So when we come to investment, we always think of what other values that we can create after acquire the asset. Just like what we have on Gem, we acquired 2 years ago, the valuation has went up to around 8.4%. So in that case, if you look at it, actually it's a good increase. I think the second, when it comes to divestment, we have to look at whether the properties has already maxed up the values. That means we have no more other things that we can do to improve on the valuations or improve on the cash flow. If that's the case, then we will ready to divest. So we do actually do this optimization strategies and planning on an ongoing basis. So yep, hopefully this share enough colors for you.
Yes, definitely has. There's one question on the 313, the Live Nation JV. Sorry, excuse me.
Yeah.
Yeah, the land X parking lot beside 313 has not been developed yet. I understand that the lease 3 years from government for 10 million. When is the expiry for the lease and how is the JV progress with Live Nation? Thanks.
I think the JV with Live Nation progressed very well. I mean, if you were to go to the site now, you will probably see some uh, plan and something set up there to really start working on the site. So while the project do push out a bit, I think it's really due to some administrative issues and administrative approvals that we need to get through. At the same time, I think COVID do hold us back, but I think don't worry about how long has been passed. I think more importantly is that how we sort of manage the project in a way that actually in the best interest of the unit holders. I think just to share with you, I think Live Nations, while we do actually have budgeted for 10 million to the site, honestly, we are not going to spend any of the money going forward, or rather, I mean, minimum in a way, because Live Nation is the one that is going to pay for the whole construction. I think that hopefully the unit holder feel that it's a worth of waiting, because that's when we try to negotiate with Live Nation to say that, hey, I mean, beside paying us rent, you also have to pay for the construction of the site. So and they agree with that. So that is the I think the best outcome that we can actually achieve. So no compromise on any of the parameters on the income side, but we managed to sort of push out the cost construction cost to sort of like in uh, to sort of to Live Nation, so that in that case, I mean, because the whole development that certainly helped them very strategically. So in that case, we managed to sort of negotiate in a way that it actually give them a very good kind of investment values. But at the same time, for us is that we defend ourselves without actually incurring any cost of that, cost of constructing it. So hopefully this gives again some colors to you on and understand while we are waiting, we are not actually really sitting there, but we are trying to sort of improve the values to the unit holders and the position of ourselves to position ourselves in a way that we will not need to sort of like have to incur something that we is beyond what we think uh, is to the best interest of unit holders. So hopefully that give you some colors.
Hmm. Okay. What is the target gearing level?
Oh, I think certainly I cannot say that I mean too much, but I think certainly we will be. I think this current level is something that we should be more or less at this level and more comfortable at this level going forward. I think we should maintain at this level.
Okay. I think Bilin went through this in the presentation, but do you have anything to add? What is your percentage of leases that are expiring or defaulting in the near term, and how are you managing it?
I think there's only left around 6% by GRI, if I'm not wrong. That I think you mean the renewal, right? Leases that
Yeah.
yeah, basically for the mall, right? For the mall, yeah. If let's say the mall, I think we left only very minimum percentage, to be honest, and that shouldn't affect too much of our numbers on. I think first of all, it will not shouldn't affect too much of our rental reversion numbers that we announced on first quarter, because we do actually do a lot of renewal in the first quarter of the year, of the calendar of the financial year. That's why uh, and we achieved the 11.4% of the rental reversion. That is probably the bulk of it. So in going forward, I think the leases that we have, first of all, is not major. I think it's not going to move the needle too much. So I'm quite comfortable that while we do actually have around, if let's say based on GRI, about 6% of the leases, they are ex- they are yet to be finalized, but I don't think it's too much of a risk for us to maintain a very positive rental reversions as we have stated on first quarter. At the same time, a risk for us to renew these tenants. Yeah, I think
Mm.
as you look at our portfolio, if I say just the mall itself is all 100% leased out, or very close 99 over percent. So I think is we are more selective to retain or to replace instead of just simply renew. I think hopefully you understand these three retain, replace, or renew. So we always play around with these three words to make sure that we get the best value from the unit holders.
I see. Is there any lease default or leases that are likely to default in the near term?
I think so far, leases are healthy. I mean, we constantly looking at what we going to change and replace the tenant. As I
Mm.
said, maybe a fully 100% lease. So we shouldn't expose our unit holder to any other type of default risk and all those things. If let's say we are under under occupied and all those things, I mean there might be risk. But I think for 100% leased out more, or two of the this 100% leased out more, I don't think we should expose unit holders to this risk. So far, I think all good. No much of this default as we said.
Okay. Yeah, there's a question about the sponsor. Your sponsor reported a huge billion-dollar loss and has indicated it will make strategic shift to focus on Australia business. Will your sponsor sell its stake in the REIT, and will there be a change of sponsor coming soon?
I honestly cannot answer on behalf of the sponsor, and also I cannot represent my sponsor on this forum, because this is mainly a forum for Lendlease Global Commercial REIT. But I think the sponsor will do actually have some strategic thinking of what they are doing, and given that the REIT actually has been listed and been technically performing relatively well, I think it will still be relevant on the strategy in a way. But again, I can't comment too much. But certainly, the sponsor will will go through their strategy thinking and see what is the most relevant things for them to do.
I see. Your office occupancy is at 81.7%, which is quite low. And why is it so low?
I think the occupancy for for the office is low because if you follow us, you know that our building three is actually is going to transform from a single tenants building to a multi-tenant buildings. So we are in a verge of actually leasing it out, and the leasing activity is going relatively healthy. And also at the same time, while we take back the building 3 from the previous tenants, which is now still our tenants for building 1 and 2, because we are in Milan, we have 3 buildings. Only take back 1 building, but the existing tenants still occupied 2 buildings. They are actually giving us a supplementary rent, which is actually a rent that is good for 2 years of our running costs. So in that case, we there's no dip on the cash flow while we do these leasing activities for this coming year and one of these 2 years time. So in that case, that will cover us while we sort of lease it out. So we already got this supplementary rental, and it's already recognized in our book. So if let's say we can list out early and the existing tenants start to actually pay for the renter, then it is actually even more positive for the unit holders. Yes. So hopefully you understand is that we take back out of the 3 buildings that is leased to the tenants, which is called Sky Italian in Milan. We took back 1 out of the 3, and we want to convert it to a multi-tenanted building. And the reason why you want to do that is because we see a 50% uplift of the rental that is paid by the existing tenants. If let's say we do a multi-tenanted, and that is validated through our process, and actually those tenants that we bring in fact, are paying 50% higher than what we have with the same tenant, with the previous tenant that is paying. So that is something that we try to sort of rectify and actually bring values to the unit holders.
Mm. Yeah, there's a very specific question regarding your expectations for the leasing of this space at Building 3 over the next, or rather over the rest of this financial year. So there's only like 50 days more or 40 days. Yeah. So do you have any
I
insights
think
on that?
I expect it to actually fill up by probably another 20 over percent, which I think is
Yeah.
not difficult. It's just a matter of how we sort of close out the deal. In fact, we already in a very close. We are finalizing some number. In fact, one of the tenant that we have, while we haven't sort of signed the agreement with them, they already put our buildings as one of the office that they have around one of the location they have in the website already. So they are more eager to sign with us than we sign with them. So hopefully, so with that being clear, hopefully you understand that. I mean, we are able to sort of achieve probably higher numbers of occupancy compared to what we have now.
Mm. Okay. Have you seen the banks start to be more aggressive and lowering interest rates, or are they going for a more wait and see approach?
I think banks are being banks. That's why you see banks share has been trading very high. Nah, I think they are still very reactive. I mean, no one try to be proactive to sort of lower the rate. But I think is but again, rate is very market driven and all those things. If let's say they are not doing the right things, and the other banks are more hungry with that, I think that's when the rate or rather the deals or transaction will move to the other banks, and they will lose out on the numbers also. So to bank, I think certainly there are some banks that are more hungry. I think I would say likely will be the more foreign banks and the local bank. But once this bank start to offer and the other banks aren't able to feel that they are losing transaction, then they will also start to cut rates. So it's just the momentum, the domino effect of the whole momentum. That's all. So they are not aggressive, but I think there are factors that you can base on it, the future rate and all those things. You can base on it to sort of like give a gauge.
Mm. Okay. What are your biggest near-term challenges?
I think the near-term challenges, of course, is to manage the gearing. I think given that people feel that the gearing probably is something of a high side, I think we can understand that, but we also want to explain that the situations why we actually end up in such a gearing is also because we acquired Gem. It's one of the good, I would say one is one of the most strategic acquisitions that we have. I think without that asset, I think during the COVID, we will be suffering very badly because Gem do actually has a very good non-discretionary spending proportions, which is very essential during the COVID period to generate revenues, generate good cash flow for the unit holders. And that's why we never stop distributing. I think we still actually are healthy. So the challenge is also because of that we end up our gearing is higher because in a very reasonable approach, you always will sort of utilize the cheapest cost of funding first when you acquire something. So that will have to be actually at the high side. So we are probably looking going forward. We will have to sort of bring down the gearing. I think that is the first and the most important thing that we are trying to manage. Of course, as we also shared, we will continue to active manage our asset. If you look at our performer asset, the reversion is something that is something I would say is remarkable. I think the other things, why I say remarkable, if you compare across other, I think landlord in the industry, I think the numbers is really something you feel is the right numbers that you should look forward to. I think the other thing is that I think we also actively managing our costs. If you follow our announcement, you know that we actually managed to bring our electricity tariff down to approximately 30%. I think that is a good saving if you look at our previous announcement of how much is the utility cost of overall cost, and if that is a saving, again, is a very good saving for the unit holders. These are things that we proactively managing ourselves to manage the portfolio so that in that case to improve the returns for the unit holders. I think hopefully that shares some color.
I see. Let's move towards the longer term. There are quite a few questions on that. What are your key growth drivers over the next 3 to 5 years?
My key growth driver will certainly be sorry, I think I'm running out of battery. I will actually have to give me a sec. Yeah, sorry, all good now. I'm recharged.
Okay, yeah.
Yeah. So sorry, I missed your questions.
Yeah, what are the key growth drivers for lendlease over the next 3 to 5 years? Yeah, so mid to long term.
I think for those that understand REIT, I think the REIT in order to sort of leverage on what they have established, is they have to continue to sort of grow the size. I mean, not every portfolios will certainly be able to sit around and do nothing. So why the size matter is because as you grow by size, I think their asset that is more obsolete, not obsolete, but it's actually due for refurbishments or wherever, were able to actually stand out for a while, and the new asset were able to sort of continue to perform to cover the shortage and all this. So these are the whole how the whole things will need to react, and also how need to sort of like work as a portfolio itself. So I think the 3 to 5 year terms, I think we will be looking at how we can sort of slowly grow the portfolio. But of course, the portfolio need to grow, I think, with very clear things in mind that we can able to enhance value once we acquire, just like what we have on GEM. Again, I always say, because that is the only asset that we acquired since IPO, but it's the huge, super huge asset and bigger than IPO asset itself. But that itself we were able to enhance value growth more and more, so that in that case it become a very key asset for the whole portfolio. So these are things that we want to always bear in mind, that I mean there are things that we can unlock values. I think there are things that we can sort of continue to enhance. Well, actually, we should also remove, I mean, some of this asset that is, I mean, less of a productive, or rather we have maximized the values to it. So I would say that in the short term, in a simple terms, we will we will apply the optimization strategies to that. But of course, I mean, given that sustainability has become a key issues going forward, and the government is looking at how to control and sort of watch over properties that actually giving very high carbon dioxide, to sort of either punish or I mean, provide something that is not very favorable for the owners. I think that's something that we must be also watchful. So we have to look at things that is actually future proofing, at the same time helping us to sort of maintain a good values.
I see. Okay. Can you give an update on the divestment of GEM's office space, and what is the real reason for this divestment, and what are your chances of finding a buyer?
I think GEM office, if you notice, basically is actually is occupied by one tenant itself, which is the government tenant, and this tenant has a very long lease with us. I think it will probably has another easily more than 20 years of runway. I mean, about that. So I would say in terms of profile wise, actually is a super good tenant, super good cash flow and all those things. But can we actually do more because it's single tenanted and it's long will? I think the answer could be no. So that's why we see, I mean, we actually exploring the opportunities in whether we should able to sort of divest this asset and see whether we can sort of redeploy the cash to somewhere else that we can actually generate better values out of it. So it's not something that we don't like, but it just said just that this asset has sort of like probably already maximized or close to its maximizing its value. So it's something that probably we just looking at options or opportunities that we can actually better redeploy, better deploying our cash and all those things. So the progress of this divestment actually actually going well. I think we have options, just that we want to see what's the best option to be tabled to the unit holders when the time is right. So not immediate, and we are not. There's no fire sales going on. Just hopefully you understand. But we just need to see what is the best way to enhance value for the unit holders. And while asset management, active asset management, all those things that we do enhance value, investment and divestment could also enhance value. So this is something that hopefully the audience understand also.
Okay. Yeah, there's some questions about the dividend sustainability. So can you share insights into your dividend sustainability and any potential changes to your distribution policies in the future, like payout ratio, all these? Yeah, thanks.
Okay. At this moment, I would say that any change to the payout ratio will certainly not be favorable for the unit holders. I think given, I mean, given that the percentage, uh, anything that you save, if it's taxable, it will be taxed at the corporate rate of around 17%. So in that case, that's why the payout ratio, we we, we, we will at our best most maintain that for sure. I think as to the dividend performance, I mean, barring any kind of unforeseen circumstances, I think few things I have already highlighted. I think the reversions will be, I think, relatively healthy, given that you know that we already uh, do a lot of reversion for this year and for this quarter, just for this financial year, we already have around done most of it. So in that case, and that is reported around 11.4% rental reversion. Again, I think that will be something you should expect it to be healthy. And also the office rental review, as you have pointed out, is also something that is going to be something favorable. Although I can't share with you too much yet because it's not concluded, but it will be something. If I tell you, I mean, for the past 5 years, the rental for suburban did actually increase by around uh, uh, high high teens number kind of things. Then again, you should be able to expect it should be a good numbers for the reviews results coming out. So I think of course the saving of the in the tariff that we have, the electricity tariff. Again, if you go back to work out your number again, I mean, how much utility cost is part of the overall ops cost, and the saving, the respective saving, and how much it is. Again, hopefully give you some colors.
Mm.
So I didn't tell you anything, but I just tell you all this that you can sort of work it out yourself, right? And also at the same time, uh, I think the interest rate, if you are a strong believer, the interest rate will only go trend down. And then again, given we have already 30%, we only have 30%, rather we only have 70% hedge and 30% exposed. I think that again will benefit because usually the short term rate will be benefit from rate cut compared will be compared to the longer term rate. I think that hopefully gives you some color to it also. I think that hopefully give you enough understanding of our DPU. I cannot give you anything more than that.
Yeah, that is clear already. Yeah, thanks. Will you acquire more of Parkway Parade?
I think Parkway Parade is a very interesting acquisitions, the first 10%. But whether we will increase more, I think that is quite subjective because the initial 10% that we acquired is because we just want to be one of the investors in the fund. So that in the case, as and when there's opportunity for us to grow, we due to some divestment of the other investors, we can always be have the preemptive arrangement to sort of acquire that. So, but it might not be our uh, immediate plans to actually grow that the involvement of Parkway. So in that case, I would not say it's immediate, not priorities, but we are there because we just want to have the preemptive right because it's a fund structure. So in that case, if you are not an investor, you will not have the advantage of being aware and also be taking the first. They will not be giving you the first right to acquire the asset. I think that's the thing.
Mm, I see. How does shifting of the Paya Lebar airbase affect TLQ's business in the long run?
Wow, I think that one, I don't know whether I can speak on behalf of the government, but I think it certainly, I would say that because it's a very huge site, if we're going to transform, it will certainly have more residential. Probably it will definitely have also more offices and traffics and all those things. I think that will help. I think that will help the surroundings. I think surrounding malls and all those things. Yeah, in short, I can only say that because I cannot say too much on behalf of the government.
Mm. Okay, is there a target AUM ratio split between retail and office that you are maintaining?
I think technically there's no target of AUM and retails AUM split between retails and office, but there's I mean to me, if let's say I'm looking at retail as something that we can create a lot of exciting activities and in that case translate to values, when office is rather a more stable kind of asset which give you a very stable cash flow. I would say that probably I would say retail about uh 60 56 60 and but office probably around 30 or even slightly 40 depending actually why it actually is a range depending on the how the stability is of the global market it is or rather the Singapore market also. If let's say the market is stable, of course everyone will take more risk. Having a higher retail means that you can take more risk. If let's say it's a very uncertain market, office asset might give you a more stability cash flow. That's why it's actually at that percentage depending on how we want to how we want to swing the percentage depending on the market rather the economic situations.
I see. Yeah, thanks to the audience for all your questions. It's almost one. Let's answer one more. And what would be your key propositions for new investors to invest in lendlease global commercial REIT?
I think for us, we just continue to be present in Singapore and try to sort of hopefully grow our presence in Singapore through our portfolios. At the same time, a lot of things that has been working against us start to ease off. I mean, if like, I mean, what actually has been punishing us is actually the interest rate movement. But again, if let's say you believe that is going to ease off soon, I think that will help us. And yeah, and the asset continue to perform relatively well. I think with the positive reversions, with how some of the cost controls that we have and all those things, that will stay. I mean, of course, I mean, if you have that kind of values and you continue to able to sort of enhance them more, I think that will stay. But the interest rate is really something that not too much of my control. So in that case, that affect us. But if you believe that will ease off, I think that will be a very key value propositions for our new investors to acquire that. And also activities of people that long concerned about the Live Nation site has been now started already. So things has been also continue to grow, do relatively well. I think yeah. So if let's say interest cost doesn't pose a concern to us, I think if you are a strong believer of Singapore asset, we have around 90% of the Singapore asset. I think hopefully that gives you some strong uh, uh, belief in our REITs.
I see. Let's squeeze in one last one. What is the preferred option to refinance the perp callable in 2025?
Okay, I think that is something that we are looking at whether we should sort of reissue a new one or whether we should actually sort of roll over the existing one. The difference between these two action is depending on the liquidities of in the market. Because if you were to roll over the new one, of roll issue, sorry, issue a new one. I think basically you have to say whether there's people that are going to take up the new subscription. I think the answer is actually yes, to my observation, because if you are following the derivative or DCM market, you will notice that there's a new bonds, a lot of new issue of bonds and etc. All those things. These people that subscribe to bond are also people that will be subscribing to perps, and perps, in fact, giving them a more better value proposition. So and the activities actually are quite active nowadays. So I would say that it's actually pretty uh, easy for us to actually issue a new perps if let's say we want to. Actually, if let's say liquidity is a concern, we can also roll over the existing one, and it's not an issue because perp actually allow you to roll over, and every time you roll over can be rolling over for 6 months, and you decide whether you want to redeem it again. So every 6 months you can consider redeeming it. So for us, while it seems to be something that we need to make a decisions, but it's not something that is not it is something that we cannot done with a solution. We do actually have several solutions, but I just make it as simple as whether we want to issue a new one or to roll over existing one, and that based on the liquidities availabilities. But if let's say there's a availability of liquidities, which I believe, as I what I observe on the bond and all those things, issue a new one is not an issue. And why issue a new one seems to be a good option is because, again, I talked about margin earlier on the debt, and the debt margin. If let's say the borrowers from the banks already reduce our margin, I would assume that the perps or the perp subscriber will also expect the margin to drop. So that is to the advantage of the unit holders. So that is something that I would just want to share with the unit holders, but it's only based on these two scenarios for the time being until we have more clarities based on that.
I see. Yeah, that's very clear. Yeah, thanks, Kelvin, for answering so many questions, as well to your audience for all your questions. Unfortunately, due to shortage of time, we cannot answer all. Yeah, so Kelvin, I'll leave the last couple of minutes to you for any closing remarks that you might have.
Uh, I think I don't have too much to sort of share to I already share a lot. I think most of them also is something that I just want you all to watch out is really how well we have performed on the mall in terms of reversions, how we cut the cost, and how interest rate will depend out. And the key, if you believe that the key things that actually affect our performance is the interest, though, if let's say interest rate is moving to our favor now, I think probably it's time for you to see what's the best way to position ourselves. In our REITs. But if I think that probably is all, but I would like to wish you guys a Merry Christmas and Happy New Year in advance. And thanks Brian for giving us this platform to keep in touch with our very important audience and investors.
Yeah, thanks again, Kelvin. Yeah, so once again, I'd like to thank Kelvin and Bilin for the presentation and answering so many questions. Yeah, so with that, that brings us to the close. We hope to see you again soon.
Thank you so
And
much.
yeah,
Bye
bye-bye. Thank
bye.
you.